One of the hardest things to do is trade inside of a consolidation. Number one, understanding when we're likely to go into a period of consolidation. And number two, where that consolidation is likely to occur inside of a dealing range. All of that I'm going to break down in this video today. So let's just get into it. Here we have the euro dollar, and this is on a 4-hour time frame. And there's quite a lot of data on this chart here, and generally speaking, when you're looking at more of a higher time frame perspective, you want at least this much data on your chart so that you can get the initial dealing range in. Now that's very, very important, and before I move on, I want to just elaborate on that a little bit more. Sometimes I see charts that are far too zoomed in. They want to zoom out to at least get the parent dealing range in. So as a rule of thumb, the highest high and the lowest low that you can see inside of a decent sample size of data. So for example, here we have a dealing range high, and here we have a dealing range low. And we have all of this data contained inside of the dealing range high and this dealing range low. Now, why have I specifically chosen this dealing range low here and not this one or this one? Well, I'm glad you asked. As you get more familiar with understanding DRT and how to select the correct dealing range, you're automatically, through experience, going to understand where you want to anchor your dealing range based on algorithmic price delivery. So when I'm assessing this piece of price action, I'm looking here at this area of consolidation first. So my eyes go right to that. And then I can see that we had a really large expansion away from that area of consolidation. Prior to that expansion, we have this inefficiency, and we can see that we've completely rebalanced this area and spent some time here. I therefore want to use the last leg inside of this consolidation before price expanded to the upside, which would of course be this swing low down here. And of course the highest high inside of this range, which we've run buy side liquidity up here, is going to be the dealing range high. Now if you get confused, it's not the end of the world if you use this as your dealing range low. I mean, they're quite close in proximity, right? And after getting feedback from a lot of newer students, dealing range theory is really more geared towards those who have a little bit more experience with algorithmic concepts and have a general basic understanding of algorithmic price delivery. But the more you do this, the more experience you're going to get and the better you're going to get at plotting your dealing ranges. Now, there are many ways to calibrate a dealing range. And again, I can't explain everything in just one video, but I am going to cover them throughout the duration of this next year. So if you haven't liked and subscribed already, then I would strongly recommend that you do so. Now, for those of you who've been through my previous videos, you should be able to identify what type of dealing range we have here in front of us. This is a type 1 dealing range. We can of course now plot our graded levels once we have established the dealing range, with our DRH being our dealing range high and our DRL being our dealing range low. This will have major buy side liquidity above the dealing range high and major sell side liquidity below the dealing range low. Any swing highs or swing lows inside of this parent dealing range will contain minor buy side or sell side liquidity pools. And of course, the grades inside of the range are going to be our 75 DRT level, the 50 DRT level or equilibrium, and the 25 DRT level. Now, straight away here, you can see that when we have a type 1 dealing range, we anticipate price to run from a premium back into a discount below that 50 DRT level. And we can clearly see that has happened here, right? Price has dropped lower into a discount market. Notice where it has dropped into, our 25 DRT level. Also note the bodies over here. They're failing to close below that 25 DRT level. Again, this signifies strength in the market. Now, for those of you who have a little bit more of a deeper understanding on algorithmic price action, you should be able to see the buy side imbalance, sell side inefficiency over here, And you should also be able to see our high probability order block, those 2 consecutive down close candles that nest inside of that lower quadrant between the dealing range low and the 25 DRT level. Again, I've explained this in previous videos. Note the opening price of the order block, which is this red dashed line, how that overlaps with that 25 DRT level. And also we have the consequent encroachment, which is that black dashed line. And you can see the reaction that we've had over here. So we have a converging of arrays with that 25 DRT level. Since the bodies are showing that they're unwilling to close below those key price points, and we're inside of a type 1 dealing range where we are anticipating higher prices. Again, for those of you who have been with me for a while, you will know that I've been calling the euro higher for quite some time now. Now, what do we see price do? It turns around here, and then we see it run through the 50 DRT level, and we find some resistance at that 75 DRT level. Price then drops lower into our 50 DRT level, or our equilibrium price point, and note what it overlaps. We have a buy-side imbalance, sell-side inefficiency nested at that 50 DRT level. Again, note the bodies here, they're failing to close below that fair value gap, again signifying strength. And then we see the reaction higher, breaking back above that 75 DRT level. Now, I'm going to take this piece of price action here and I'm going to zoom in, and we're going to get a little bit more detail to see what's going on. Like so. The first thing I want you to know is how we have the 75 DRT level here from the parent dealing range. Now notice all of this price action, how it's consolidating around that 75 DRT level. If we are bullish and we are around that 75 DRT level and we anticipate the market to reprice higher, typically we will see a consolidation around this level, especially when we have the economic calendar that implies a consolidated market profile. Now, I'll get onto that in a second. But first, we can see this dealing range from this swing low to this swing high. Now, of course, this is a smaller fractal dealing range inside of the larger parent dealing range. Again, we are considering higher prices. So we have here a type 1 dealing range where price drops lower below the 50 DRT level into a discount market. Again, we can see these 2 consecutive down close candles acting as an order block, and we see the opening price of that order block. We consolidate here around it, hit it once, twice, and we also have the inversion fair value gap. Notice again that we're failing to get below that. In fact, in this one, we're not even getting near that 25 DRT level. So again, this shows strength behind the market. Whilst we're here, price is moving inside of a range, as we can clearly see. Again, it's consolidating around that 75 DRT level. Now, smart money have very deep pockets and they cannot get all their positions out in one go. And this is why we will see the order block traded to many times before we see a reaction higher. This is true support in the market. Now, let's unpack this a little bit more. I'm selecting this dealing range. We have the dealing range high over here. Then price dropped lower, and as we can see, it went into our discount level on the previous dealing range. Notice that it's completely rebalanced the inefficiency to the left. And then we have seen price run higher away from this area of consolidation. Now, I want you to note something crucial here. You see these bodies, they're relatively equal. And we have this huge wick that has traveled outside of the dealing range. But the bodies close back inside of the dealing range. This is significant. This means that price isn't yet ready to move outside of the dealing range. Therefore, it is waiting for something to occur. It's waiting for a specific time. So this wick is a stop run. Now, if you've been following the DRT series and you've been through the DRT model, when we see this occur, we want to drop to a lower time frame. So Here we're going to drop down to the 1 hour time frame. Now on this time frame, you can see how price ran through our initial dealing range high, and then we closed straight back inside of it. It left this fair value gap, which we obviously traded to, overlapping with the dealing range high, and then we dropped into a discount market below the 50 DRT level. And then we accumulated down here on that higher time frame order block inside of an extreme discount. Now, this specific type of dealing range, I refer to it as a type 3 dealing range. Again, type 3 dealing ranges will occur at specific areas inside of a dealing range, but they have to occur through some form of economic news event where there's going to be a timing element. The algorithm will contain price inside of the dealing range until it's ready to move outside of it. And this will allow smart money to accumulate long orders if we are going higher. So what do I mean by that? Well, firstly, we have established that the market wants to run higher. We've established that we're in a type 1 dealing range, and we've established that price is at that 75 DRT level. Now, if you note closely here, we have the dealing range low here and the dealing range high here. And this red line here is our 50 DRT level inside of that minor dealing range, which very closely overlaps that 75 DRT level. So that's one clue over there, when we can have an overlapping of dealing range levels from the higher time frame down to a lower time frame. They're usually very, very strong areas. And I'm going to show you why in just a minute. Secondly, we have the economic calendar. The one that stands out mostly inside of this is here on Wednesday, and you can clearly see that we have CPI here. Now we know with this red folder CPI news event, there's going to be a whole lot of volatility in the market. So that's the first thing that stands out to me. Now, when is this going to occur? At 8:30 a.m. New York Eastern Standard Time, so during the New York session. I can mark that out here on my chart, knowing that there's going to be some sort of high impact news and an injection of volatility that's going to come into the marketplace. I then look to the 2 days prior to CPI, so on Monday and on Tuesday. Now here on Monday, we can see that there's no news over here. On Tuesday, we had Trump speaking at 4 p.m. And other than that, there was no high or medium impact news. And this is all occurring prior to Wednesday, where we have that CPI. So I'm anticipating some form of a consolidation going into CPI. Now, why is that? And the main reason is to engineer liquidity in the market. So when I'm anticipating this to occur, when we are at a higher time frame key level like that 75 DRT level, when I'm anticipating some form of consolidation, where we have a high impact news event like CPI, where we have very little news the previous days prior to CPI, when we've had a large expansion that has already raided buy-side liquidity, and when I've already seen on a higher time frame that there has been a stop run that's occurred, again indicating that price isn't yet ready to leave its range. Now I can understand that we are likely to be in a type 3 dealing range, in which case I'm going to look at Monday and Tuesday's trading as a consolidation that is likely to stay inside of the range until we get to our CPI news event. So let's drop down to a 15-minute time frame here, and we can get a little bit more detail here from Monday's trading and Tuesday's trading. Now, as expected, you can see Monday's trading, we have had consolidation. We had a high formed up here inside of an extreme premium, and then price dropped lower back below the equilibrium price point, or that 50 DRT level, forming a low inside of a discount market. Now remember, inside of a type 3 consolidated dealing range, price will ideally move from an extreme premium to an extreme discount. And if we are trading inside of this type of dealing range, we only want to take trades at the extremes of the parent dealing range. So what do I mean by that? Well, here, price drops and closes through the 75 DRT level, leaving this fair value gap. There is also this up close candle which is a high probability order block next to it. And then we have this down close candle, which is also a breaker. So we have a number of PD arrays nested at that 75 DRT level. Now, again, if you've been following dealing range theory, you know by now that high probability arrays are going to be nested at these DRT levels, because these DRT levels are the algorithmic structure of any given market. It's what the algorithm is seeing to print these arrays on. So what happens? We engineer some buy-side liquidity over here. Again, we're in a consolidated market, and that's typical. And then price runs up one more time into that fair value gap. Do we see price here close above the fair value gap? No, right? It turns around and drops lower with this close, closing below the previous swing. And then it drops lower. Now it's in a consolidation. This is Monday, it's pre-CPI. We have no news today. Is it likely to continue lower? No. What it does is it creates equal lows. And this is engineering a whole pool of sell side liquidity below those lows. Then the market runs higher, eyeball that high and that low. We're around equilibrium there. And inside of that level, we have this fair value gap. Also note the 50 DRT level here and the higher time frame 75 DRT level, which is this fainter orange line. So we've got a whole lot of resistance at that area. Price then really drops lower, sweeping all of that sell side liquidity below the market and into that higher time frame order block down here. So remember, that was the opening price. Not only has it dropped into the opening price, it's also dropped below the 25 DRT level into what? An extreme discount. So it's traveled here from an extreme premium into an extreme discount. Now, since we're inside of a type 3 dealing range, we want to sell here and we want to buy back down here. Or we want to buy down here and we want to sell back inside of an extreme premium. Again, they're going to take all of the liquidity below those equal lows, pair that with long positions inside of an extreme discount, and then offset those positions against the willing buyers inside of an extreme premium in the form of these retail buy stops. Let's move along here and see what actually ends up happening. I'm going to scrub to the left a little bit, and this is now Wednesday's price action. This dotted line here delineates 8:30 a.m. New York Eastern Standard Time, the time where we anticipate the CPI news release. Now think about this. We already know at 8:30 a.m. we're going to have some sort of volatility injection into the market. That economic calendar is a roadmap. It's a TV guide for us that tells us when to anticipate volatility in the market and what kind of profile is likely to be in play during this type of week. So what happens here? Firstly, we can see that at Wednesday 12 a.m. we open and price drops below the opening price into our 50 DRT level down here. Again, that overlaps with that fainter orange line, which is our 75 DRT level. Again, the converging of DRT levels from a higher time frame down to a lower time frame. Just look at the reaction that we have over here, right? Those bodies, again, failing to go any lower. I can spend a whole hour just on that piece of price action alone, but let's move on over here. We see that from here, we end up with a reaction, price running higher. Now what we've done is we've created this dealing range low, and we've creating this dealing range high. This allows us to define our dealing range and plot our dealing range or DRT levels here. Now again, we're anticipating higher prices. We're anticipating price to run for the dealing range high. Again, I've had plenty of examples even throughout this DRT series of me having real executions and real trades going long, right? So again, we're anticipating price to drop into a discount below the 50 DRT level over here. But what we want to do is wait for CPI. Now, CPI is generally going to be a continuation sort of event, whereas something like FOMC and non-farm payroll, we usually get a lot more whipsaw where we see the fake move first and then the real move unfolds afterwards. With CPI, it's usually just sort of one shot and it runs off, and it's generally going to run in the direction of the higher time frame draw, right? So how can we trade this? And for the record, I never recommend to any of my students that you should trade CPI. Unless you really have a deep understanding of algorithmic price delivery and you have the experience in here and you understand how to manage your risk, you should never ever trade CPI if you're new. You always have the risk of something like slippage, which can, especially in these kind of climates, really do you damage. So that's just a word of caution here. Now, let's just move on here and see what happens. That's the CPI candle. So at 8:30, we see price drop below these engineered equal lows. Notice how they did that just before CPI, and then they had all of this engineered buy-side liquidity above the market. At 8:30, it drops lower here into a discount market. Notice what else rests at that 50 DRT level on this minor dealing range. We have our high probability order block that nests at that 50 DRT level. Note how it reacts from the mean threshold of that order block. And then we have this massive move higher, running for that dealing range high. This is not buying and selling pressure. On an event like CPI, for it to nail a level that we anticipate because of where it's nested, because of the algorithmic structure in price, that wasn't sellers running out at that exact level. That was the algorithm engineering liquidity prior to CPI. And then we have time down here, 8:30, and price aligning. And then the macro delivers to instruct the algorithm to spool price for buy side above our dealing range high. And ultimately, it runs much higher. It drops back into our dealing range high. Again, find support here, and this is another indication that price wants to run higher, is that we're not seeing price close back below that dealing range high. Remember when we had that previous stop run, it ran higher and went straight back into the dealing range. In this case, we leave this huge inefficiency, and price over here is showing that it doesn't want to come any lower, and ultimately it runs for that dealing range high. Now, one of the hardest things that you're going to find is understanding really where to anchor your dealing range highs and lows, and that's just unfortunately going to take time and a way of experience. But the way you're going to find it is by doing exercises like this every night, going back through your charts, annotating things after the fact, and journaling it. And the more you do that, after time, you're going to automatically train your eyes to understand where the dealing range highs and lows are going to form. Again, this isn't a get rich in 90 days system, and there is no get rich in 90 day system. This is going to require work, but if you understand what I'm showing you here, this is the highest level of ICT outside of ICT's work in the most simplest format. And I'm saving you years of real trial and error and tens of thousands of hours worth of study. Now, if you want more information, especially if you want to really build a solid foundation to algorithmic price action, dealing range theory, power of three, market maker model concepts, then download the free ebook below, and I'll give you more instructions on how to join my bootcamp and or my coaching program. But if you decide not to, then it's absolutely no problem. Knowing and understanding this alone can really change your life if you put the work in, right? Anyway, I try to keep these lessons as short and concise as I possibly can, whilst trying to throw a ton of gems at you. So if you like what you see here and you want me to do more videos, please like, subscribe, leave a comment below on what you want me to teach next. I literally can teach you absolutely anything in the ICT library. And I think you've come to find I'm not your typical ICT YouTuber. I do actually have the years of knowledge and teaching behind me. So I hope you have found this insightful, in the words of ICT, and I'll see you in the next lesson.